Welcome to Business Minded, the newest home of financial and economics news, curiosities and education. Before we begin, let me just ask you to leave a like to this video and subscribe to the channel to help us grow and support our vision. Let's begin, guys. Number 1. The earnings per share. The EPS is fundamental whenever we have to value a stock. And for those of you who are still beginners, it's one of the first things you have to look at when evaluating a stock. This ratio tells you how much of a company's income can be allocated to each share. It's like putting all of the company's earnings on the numerator of a fraction and dividing it for the number of outstanding shares. In this way, you have spread the company's total earnings on each share. So, how can I use it to see if a stock is valuable? You always have to look at the stock with the higher EPS. Suppose you are evaluating two stocks, Alphabet, which has a $10 quarterly EPS in 2020, and Nvidia, which has a quarterly EPS of 99 cents in 2020. Based on this, we can say that each share of Alphabet accounts for $10 of the company's earnings, while each share of Nvidia for just 99 cents. A higher EPS is a synonym of higher profits. So be careful to look at EPS when you buy a stock. It is a great measure of profitability, perhaps even the best one. Number 2. The dividend yield. As we all know, dividends are one of the major factors whenever an investor has to decide whether to put its money into a stock. And if you remember a little bit about financial accounting, you will know that dividends are paid out of retained earnings, which are a portion of income that the company retains to pay its investors. If you are looking for a company's dividend yield, they are visible on pretty much any major financial website on the internet. But other than that, the formula to calculate it is this. Every now and then, the company may decide to pay out some dividends to its investors, and they can be either cash dividends or share dividends. Cash dividends are a distribution of cash to the company's shareholders on a pro rata basis. Remember, guys, pro rata distribution means that you will receive your portion of cash based on how much you own of the total company's shares. On the other hand, share dividends are pretty much the same thing. They are a distribution of additional shares on a pro rata basis. But remember, guys, not every company distributes dividends. The big companies, also called cash cows, such as Google or Apple, they are financially established and they are able to distribute some of its earnings to the shareholders using dividends. Other companies, mostly the newest ones or startups, do not distribute dividends since they prefer to reinvest their earnings in the company. Number 3. The debt ratio. Also defined as the debt ratio coverage, this ratio defines how much debt the company has taken with respect to the asset it holds. A high debt ratio means that the company has a high financial leverage. What does a high leverage mean? It means that the company has borrowed a lot of money, and this is not always beneficial. Remember, a high level of financial leverage is beneficial up to a certain point. Then, after a certain threshold, the cost of debt becomes too high for the company because banks will start to raise the interest on the sum they lend. Therefore, remember once again, and I will never repeat this enough, look at the financial leverage of a company, aka the debt ratio, because as companies take on a lot of debt, the risk of bankruptcy grows too exponentially. Number 4. The price-earnings ratio. The PE ratio is incredibly useful. In fact, expect in the next weeks a whole video about this ratio alone. The reason why it is so useful is the fact that it makes you understand whether the market is overvaluing or undervaluing a stock. In practice, this ratio helps you to compare the price of a company's stock with respect to the earnings that the company generates. Here, you can also see the formula of the PE ratio. If a company's price-earnings ratio is high, it means that the company's share price is high with respect to the amounts of money it brings in. This means that the company is overvalued. A low price-earnings ratio is what you're looking for. It means that the company is undervalued and there is an opportunity to make money for the investor. If you compare the price-earning ratio of Tesla with the ratio of a stable company like Pfizer, the price-earnings ratio of Pfizer is by far lower. This is due to the fact that the Tesla stock is massively overvalued with respect to the earnings that it generates. So be careful, guys, and look for stable companies that are not only surrounded by hype. This is the real way in which investors can make money on the financial markets. Thanks for watching, and don't forget to like and subscribe if you want to support the channel.